Now on Overnights,
I believe in reason and common sense.
Leith Van Onselen from Macro Business with the Treasury of Common Sense.
Common sense never goes out of style.
There is a lot of economic news to talk about this week, and we chat about these issues with Leith Van Onselen, who is the co-founder of Macro Business, every Thursday morning. G'day, Leith.
G'day, Clinton. How are you?
Good, mate. The Treasurer, Jim Chalmers, tell me, should he be jumping for joy that he has released a second budget surplus and a bigger one than had been forecast?
Yeah, look, it's certainly, you'd obviously rather have a surplus than a deficit. And, we have had two consecutive surpluses. This one's 0.6% of GDP, and it's a little bit higher than what they expected. It's obviously good news, but the drivers behind the surplus are a little bit concerning. And also, the forward projections for the surplus are actually, we're about to go into a deficit for basically as far as the eye can see, because we've got rising unemployment. We're also going to have lower migration going forward, as well as commodity prices, falling as well, which will drag on the budget deficit, as well as the NDIS is going to grow at about 20% per annum, which is one of the massive expenditure components of the budget. Now, the drivers of the surplus are interesting, Clinton. So we obviously had the commodity price boom over recent years, especially after Russia invaded Ukraine, and that pushed up commodity prices, and that's been good for the federal budget because it collected more corporate tax from that, which is obviously good for us and good for the government. The other big driver was we've had obviously record immigration and as well as massive bracket creep. So what this basically meant is that we've had more people coming into the country, more workers. Also, we've had massive bracket creep because of high inflation, etc., which has pushed everyone up in the higher tax brackets. And what that's done is basically all the benefits that have flown to the federal government because they collect 80% of tax revenue. But the problem with it is, there's two problems. Obviously, this high immigration has also buried the states in debt. So we've got this weird situation in Australia under its federal system whereby the feds collect about 80% of the tax revenue and the state and local governments collect about 20%. And what this means is when the government runs a big immigration program, it gets all the benefits through increased personal taxes, namely, but the cost of that then falls on the states to provide the healthcare, the infrastructure, all these sorts of things. And as a result, we've got the state governments are absolutely drowning in debt, especially down the East Coast. And so, it's a situation whereby the federal government can crow about it, but the states are the ones who are getting hammered. And the other thing about it is Australia's got one of the highest reliances in the world on personal income taxes. So based on this budget, the share of total taxes that have come from personal income taxes has risen to 52%, which is a record. And that's actually one of the highest in the OECD. And the other areas where the federal government collects taxes from, things like GST, indirect taxes like fuel excise, tobacco excise, those are all falling relatively as a share because a lot of the GST is actually the quickest areas of expenditure by people, which tends to be healthcare, education, those sorts of things, are actually not taxed under the GST. And what this meant is that the GST's share of revenue shrunk to 13.4%, which is actually well below the first decade of the GST when it was collecting about 16%. And also we've got falling fuel excise because we've got a shift to lower emissions vehicles, like electric vehicles, hybrids, that sort of thing. And then we've got shrinking tobacco excise because the government's lifted taxes so much per dart that people are now also smoking less, but also going illegally. So you've got this imbalanced system whereby the government's relying more and more and more on personal income taxes at the same time as the share of workers in the economy is projected to shrink. And according to the Intergeneration report, the share of taxes going to personal income taxes is going to rise to 58% over the next couple of decades, which just means we're going to become more and more reliant on personal income taxes. So there's a bit to unpack there. It's obviously good news to have a surplus, but we're putting more pressure on the states at the same time as the government has become so heavily reliant on personal income tax, which is ultimately unsustainable when you have an ageing population and you've got a smaller share of workers in the economy. It's not particularly sustainable. It's not particularly equitable to keep taxing the hell out of workers whilst all the other areas of taxation are shrinking relatively.
I had a good question from one of our listeners a couple of days ago when Jim Chalmers unveiled this. And they asked the question, what happens to the surplus, to the money? Does that simply go to paying down debt? Is that the way it works?
Well, yes, it should. It should go to paying down debt. It's also good in that it's taking money, I guess, out of the economy by not spending it. They are relieving pressure on inflation as well, because they're not stimulating demand as much as they would be if they were spending all the money. So basically it goes to paying down debt and saving it for a rainy day, which is a good thing.
And particularly given, and I know when you look at growing expenditure in the future, our interest bill will be growing in the future.
Yeah, well, especially for state governments. So for state governments, the interest bill's rocketing. The federal government, not so much, because the federal government doesn't have that much debt at the moment. But the forward projections aren't exactly good because, A, we've got this ageing population issue. B, we've got really quick expenditure, fast rising expenditure under the NDIS. So the NDIS currently costs nearly $50 billion a year. It's about double what the Productivity Commission projected, about a decade ago when it was being thought up. And it's growing at about 20% per annum. And the Parliamentary Budget Office predicts it's going to be about $100 billion by the end of it, in a decade's time, even if the government takes measures to try and slow it down. So there's going to be more pressures on the federal budget to try and fund these sorts of things. And at the same time as we've got, obviously, an ageing population and a shrinking worker base to fund that, which is why the government really needs to broaden the tax base, basically resurrect the Henry tax review, or all the sorts of reforms that were suggested in that in 2010. They're all basically still relevant, and to try and broaden the tax system so it's not so heavily reliant on just one thing, which is personal income taxes, at a time when you've got a shrinking, worker base relative to the rest of the economy, which isn't particularly sustainable or equitable.
Figures were released during the week for building approvals, new dwelling approvals, and overall, house approvals are up, but apartment approvals are down.
Oh, absolutely. They have absolutely crashed. So, listeners might recall that the federal government set a target to basically build 20,000 homes a month for 5 years, or 1.2 million homes over 5 years. So they need to hit a run rate of 20,000 homes a month. And the approvals data that came out for August showed that we only had 14,300. So that's about just under 30% below the run rate required. And the area where it's really falling down is the unit apartment segment. So they're tracking at around 12-year lows. And for high-rise apartments, which is basically where the government wants to try and poll everyone into high-rise shoeboxes, they're down 64% from their peak. And they've absolutely collapsed down the East Coast. So New South Wales' high-rise apartment approvals, that's basically anything that's 4 stories or above, is down 72% from its peak, and in Queensland it's down 62% from its peak. So we've got the government who wants everyone to live in apartments, trying shoehorn all the extra migrants into, at the same time as all the approvals data is going the wrong way, and there's good reason for that. We've got a shortage of labour, obviously. The state governments the building industry is competing against the state government's big build infrastructure projects, and also the cost of building apartments has rocketed because materials and all the things that go into building an apartment has rocketed by about 40% since the pandemic started. So really, we're starting behind the 8 ball, and the fact of the matter is it's going to be impossible to meet the government's 1.2 million target. It's a level that we've never done before anyway, and it's going to be absolutely impossible when you have all the constraints that we have at the moment with high costs and labour shortages and all those sorts of things. So really, the only solution to try and solve the housing shortage is to slow immigration right back, so that the population grows at a sustainable pace that's below the nation's ability to build houses and infrastructure. Otherwise, we're just going to keep chasing our tail.
What are your thoughts on the Coalition's position on what they're doing with APRA and regulations they have for financial institutions when they're lending money to people seeking a mortgage?
I think it's absolutely ridiculous, quite frankly. So the Coalition wants to basically strip the Australian Prudential Regulatory Authority of some of its powers to regulate mortgage borrowing. And it's basically saying that they're too strict, and because of this, first-time buyers are having trouble getting in the market. Now, I'll just remind people that the Hayne Banking Royal Commission, which came out in 2019, its very first recommendation was not to relax our lending standards. So it wanted responsible lending laws to remain, and that was its very first recommendation. Yet now we have the coalition suggesting that we loosen lending standards to try and basically pump more credit, make it easier for sort of marginal borrowers to get loans, et cetera, et cetera. And the coalition's arguing that Australia has tight credit, and because of that, people aren't able to borrow. Well, there isn't actually any evidence of that. So obviously we've seen house prices rocket. Average mortgage sizes have basically chased house prices higher. So there isn't actually any evidence. And what we know from history is that every time the government's done a sort of a demand side measure, whether it be first home buyer grants, easier access to credit, shared equity schemes, whatever, all it's ended up doing is being capitalising the higher house prices. And this is basically a recipe to push house prices higher, to increase household debt, and to compromise the nation's financial stability. And the reality of the situation, Clinton, is that the housing affordability issue is a price issue. It's not really a leverage or borrowing issue. The fact of the matter is prices are just too high. And a better solution to make housing more affordable would be, I keep saying it every time, is to reduce immigration first and foremost to a reasonable level. That would bring down prices. People just have to look at the last 4 years of high immigration, whereby we've seen house prices rise into rising interest rates. And that is highly unusual. And the reason why this happened is because we've had this structural housing shortage develop, whereby we've had hundreds of thousands of extra people coming into the country who need accommodation, and that's pushed up both prices and rents. And it's a reason why house prices have risen despite the fact we've had higher interest rates. Usually it goes the other way around. Now, so the number one solution is to cut immigration. The other one is, we could do broad-based tax reform to shift the economic activity away from housing speculation. So that could be curbs on negative gearing and those sorts of things in exchange for, say, lower income taxes and those sorts of things. And that would actually increase the share of first home buyers in the market, because they wouldn't have to compete as hard against investors, which is what's happening at the moment. And that's the fundamental reason why we've had this fall in the first home ownership rate, et cetera, which is what the coalition's trying to solve by loosening credit. But loosening credit's not the solution to it, because all it's going to do is end up pushing prices higher, which is what it always does. And that's the reason why the Hayne Banking Royal Commission, as its number one recommendation, was not to loosen credit and not to relax responsible lending rules, which the coalition's trying to go against.
Well, at least the coalition seems to have a stronger position on reducing migration numbers. Good to talk to you, Leith. We'll catch up next week.
Yeah, cheers. Couldn't speak next time.
Leith Van Oslen from Macro Business.